I'm making this video in response to a request. The conversation was about how to take a loan out against a life insurance policy. Context of life insurance policies, and then I'll jump into how to take a loan against one. By the way, it's artwork for my kids. So a life insurance policy covers a certain duration of time which payments are made for the policy, and if the person dies during that time, beneficiaries receive the money, what's called the face value. So if you had a face value of $250,000 on a policy, you decide you want coverage for how long? 10 years, 20 years, 30 or 40. The longer period of time, the more you pay in the premium. And if you got this for yourself and you died, you want loved ones to be taken care of. When you die, the beneficiaries receive that income. As a side note, money received from life insurance is not taxed. It's tax-free. Life insurance policies will ask for your age, your gender, where you live, your profession, a variety of others, but those are the primary. Also, if you're a nicotine or tobacco user, they'll ask you that as well. Many policies can be written right from where you're at home. Some policies, however, normally the higher face value policies, will require you to have a medical appointment first. There are basically two categories of life insurance: term life and whole life. Term life is much cheaper. It's paid during a certain period of time. If you die during that time, your beneficiaries receive the money. Whole life, however, is typically going to cost you about 3 times as much. The reason is it's building up what's called cash value. Whole life policies are the only ones that you can take a loan against. So let's talk about how that works. A $250,000 face value policy, if you were to die, $250,000 is paid out. For a whole life, for a male that's 50 years old, would cost about $7,000 a year. If you're taking this policy out on yourself because you'd also like to take a loan against it, then you're probably going to use PUAs. Okay, PUAs are paid up additions. Paid up additions increase the cash value of the insurance policy. This cash value is what you can take a loan against. It also is technically increasing the face value of the policy. So let's say someone wanted to be able to have a small loan amount, say $50,000, maybe to buy real estate or some other significant purchase, or maybe there's an emergency in a life event. A 50-year-old, instead of paying $7,000 per year, would pay about an additional $14,000 to $17,000 per year for the PUAs. So after 3 years, the total amount of policy payout would be about $75,000. If they did this, this would give a loan amount, or not a loan amount, but it would give you a cash value at which you could take a loan of about $50,000 against that policy. So why would someone want to do that? And I'll give you my recommendation at the end, but the reasoning behind it is a place to park cash that increases the face value on the insurance, and that is building at an interest rate. And then if you need to borrow against it, the loan that you take out, that interest rate associated with that is much less. Now, the number of examples I gave you will vary depending on who you are, where you live, what you do, and a variety of other criteria. And I did run those numbers against the capacity to have a loan in 3 years of a minimum $50,000. There are some other whole life insurance policies that if you were buying the policy and to hold for a longer period of time, 10, 15, 20 years or more, that would actually make more sense to build up the size loan that you could borrow against it. In general, I don't see wholesale life insurance policies as ways to save money. Now, there are some policies that are unique, very few, that you could consider. But at the end of the day, if you are going to buy a whole life insurance policy, obviously you have to buy that from a licensed insurance agent. I've held that license prior to, I do not have that currently. But in addition to that, I'd really suggest that you talk with your financial advisor, because a whole life insurance policy in the midst and context of everything you're doing needs to be properly planned. Now, there's a lot of divide against wholesale life insurance policies. For example, if you listen to anybody popular like Dave Ramsey, he'll say term life insurance, never whole life. And I would tend to agree with that for the most part. There may be a few exceptions, but they're rare. And so that's the reason you need to speak with a financial planner. Now, applying this to real estate, I think it makes more sense. Instead of putting $25,000 a year for 3 years, $75,000, save that up and use that as a down payment to actually buy the investment property you want. Also, if you're going to park that money somewhere, the S&P 500 index has a lifetime return of what, 9%? So it makes more sense for me as an investment vehicle to use an S&P 500 index fund, or to use that money directly as a down payment for real estate, if that's what you're wanting to do. If you have a question, respond down below. I'd be happy to help you out. If this has been helpful, don't forget to like.